Hello, everybody. I'm Jason, the Wizard of Ops. With me, as always, is Jay, Dark Matter Trade. And we are very excited to have Samantha LaDuc on the show, who's she's a new kind of Volland fan, it seems. And, you know, I started looking at her stuff, and she has some great insights on macro and intermarket analysis. So, Samantha, welcome to the show.
Thank you so much for the invite. I've actually tracked you guys for a while, so I'm a vol quant stalker. But you bring some unique, perspective in, and I also want to kind of track all of that for my clients because I'm not just interested in one particular area, but quant is absolutely what makes the market move, and I love the work that you do.
Great. No, thank you. I mean, Samantha is she's the founder and chief market strategist of LaDucTrading. She runs a financial research firm of 10 client dedicated professional traders from macro to micro. She focuses on spotting major macro trends early and then translating the complex market structure data into tradable sector rotation themes, including macro, intermarket, technical, fundamental, sentiment, and quant analysis. So Samantha's got the whole world in her hands, right?
I'm trying to interpret it in a language at least that I understand. So those seem to be the silos that make kind of make the most sense for me. But
great, that's a lot of silos, though, right?
Because they each have their own kind of weight in making up the story, and that's how I follow it. I actually look at it as very much a story that's being told, and I need to connect all those words into meaningful sentences and relay it to clients.
Excellent. So let's first talk about intermarket analysis, because I think that has a huge impact. I mean, Jay at Volland and Jay as well, we focus a lot on flows, and I mean, in particular, we focus on option positioning flows. But intermarket analysis has a major flow component because people are borrowing in one currency. There's so many carry traders, and bond liquidity is a huge portion. So tell us what you're seeing in the intermarket analysis right now. Do you see any disconnections? Last week was pretty volatile. So what are you thinking in that?
Well, intermarket for me is the study to compare and contrast across assets. So I'm very interested in how dollar obviously yields and oil will move the market. So I focus on that as a backdrop, which is oftentimes considered macro, but macro event risk can move, obviously, like upcoming BOJ or FOMC. They can obviously move the yield market, and then we are all bond traders. So as it relates to its impact on equities. But you and I study flows a little bit differently in that I'm definitely looking at option flows for sure. Like on August 5th, when there were 66% of puts were sold, not bought, and we were in a massive convexity rally that then triggered also the short covering, and we popped right up like a daisy, and we just continued right into the end of the year. This is different. This has been much more controlled selling, controlled demolition, as I like to call it. But one of the reasons why I was able to see it early for clients, and I run a live trading room, so I have this stuff up for my clients every single day, is that I could see that breadth was starting to break down underneath the surface, even though we had gone nowhere, right? For 3 months. We had the big Trump bump. We had massive volatility sideways. We weren't able to get going. And part of that, skepticism, even though there was a 0% chance of recession being priced in, even though folks were, ordering their 7,000 SPX hats. I literally wrote a post, no 7,000 SPX hat for me. And here's why. Because the macro backdrop I knew was going to change, but I hadn't seen the flows change. Right. So I couldn't get bearish until I could see the flows change. And macro backdrop meaning I knew that there was going to be obviously this focus on a new regime around pushing down literally dollar yields and oil. That was already well telegraphed, which is not friendly for the equity market. Whether you're talking shale producers or you're talking about lower interest rates, yes, but right now we actually have an inflationary backdrop where assets have benefited greatly from this inflationary impulse, and to push down yield is
it's Samantha, I think you cut out there a little bit at the end. Did you hear that, Jay, or was that me?
Can you hear me now? Is it better?
Yes.
Oh, much better. Amazing. You sound like,
Okay.
Yeah, great.
Sorry about that. Okay.
No,
So
okay.
there's this little button that says on. So I told you, I warned you, I have not had my coffee yet.
It's a Monday. We get it.
Oh my, Monday morning. Welcome. I'm Samantha LaDuc. Okay, never mind. So the macro backdrop I knew was going to be more problematic just from that. Again, we had coordinated central bank, Treasury, and White House policy intervention anytime the bond or equity market came close to cliff diving. Now we had a very recalcitrant Fed, Powell, but a new Treasury Secretary in Bessent, and of course, Trump. So I knew that this was going to be the year of volatility, but underneath the surface, not until literally December 2nd, I started to see the breadth breakdown and the net selling breakdown. So that's part of the intermarket. And then fast forward to literally Wednesday, February the 19th, I had just posted the prior day that I really thought this was going to tank, but we didn't have an air pocket of risk that had, figured in yet. It had formed underneath the surface. So the flows were weakening. I know you study flows a little bit more differently than I do, but the result is still the same. We were creating this, we were correcting in time, not price, but underneath the surface, we were weakening. Then the dollar dumped, which is a sign, and with equities, that money is going home. So basically, foreign investors, of which 17% of our U.S. equity market is foreign investors, they obviously figured this out, right? We're going to really have a tariff and trade war. We're going to have a lot more instability in the policies of the administration. And the dollar has been dropping, and it will continue to drop. So this is basically all part of the macro, but the intermarket is what I was spying to see how breadth was holding up, and it was not. And then sector rotation, last but not least, is growth to value. Growth is Mag 7. When it starts to sell off, like we had with the yen carry trade back in July, August, it hits the Mag 7 plays, the concentration risk. They de-risk and then they bid up value. And we've had a massive high beta outflow and inflow into low beta, low volatility. And that has basically been because my intermarket is focused on sector rotation. And then last but not least brings up, in lieu of sector rotation, there will be volatility. But we haven't really had a volatility spike. We haven't even had a 2 standard deviation move in the past few weeks of this 10% drawdown, right? So this is more controlled selling like in 2022. Long story short.
Yeah. Yeah. I mean, so from our perspective, we definitely, I wanted to see a vol event, right? Which to me is, kind of more quanti. We see spot vol correlation. And when VIX overreacts by 2 points or more, that's saying that there's a liquidity problem. But usually that settles down at least into a dead cat bounce later on. But yeah, I think that the intermarket stuff is very, very, those kind of flows are very important because those are the fundamental kind of macro traders that we don't necessarily see. What we see are people hedging or not. And when they're not hedging, like, you kind of saw in February, which, we saw a drop, but for different reasons. Nobody was hedging. And, there's major problems in the market. We were also into where people sold calls for their quarterly quarterly like hedging positions on SPX. So that's why we saw a big drop as well. This dropped a little bit further than I expected. I'm sure we're about to get comments from a frequent watcher, Kramer, who like to say that, hey, we're going to have a correction. And I was saying, I don't know, maybe like 5 to 7%. I don't know about 10. And we got 10. So I'll loan up to it when he comes on. But yeah, I mean, this is very interesting stuff, especially with the yen carry trade. That's something as an economist I always like to look at, but I don't have the tools as much yet anyway to see into those markets. So I also wanted to talk a little bit about FOMC, but before that, I wanted to talk. You brought up oil a lot. What do you see as far as oil goes versus the markets, or how does oil liquidity kind of play into your intermarket analysis?
This is definitely three-prong approach here on oil. One, this is a gift that I have an oil trader as one of my 10. So this is someone who just trades oil and the companies that hedge with physical. So it's not like paper traders. I'm a paper trader, right? When it comes to oil. So the point is, we all are, like gold and silver, if you're doing GLD and SLV. So I don't mean like, I don't mean paper trading. I mean, these are paper markets. They're not the real physical gold, silver, and oil. All right.
GLD, we can't get actual gold when we invest in
correct.
GLD.
Correct. So, but he's a physical. So anyway, long story short, I have that advantage that he provides his insights into the money management of oil. Are they long? Are they short? Are they not anything because there's a better trade elsewhere? Okay, so that's one thing. Second, we have, in my humble opinion, and I've been a bear since last April of 2024, falling global demand for oil. And this is not popular. And now all of a sudden, what was it last week? The Navarro comes out and says, the administration would like $50 for crude, please. And I literally said last year that this year will be the year that crude falls into the 40 to 60%, the $60 handle. And people are like, you're out of your mind. I'm like, besides a geopolitical flare up in the price of oil, we will continue to roll over. And the short term will be this recession risk vibe, right? Falling demand is, exactly, right? Recession risk, everyone associates. And that's going to be in the short term. In the longer term, and of course, it hurts terribly the oil and gas industry. But as it relates to drillers and such, they're not incentivized. But then longer term, it turns into an economic stimulus. Much like China has been transitioning to EV, this is something where they absolutely want to remove their dependency on the dollar, on the petrodollar. They're not only saying, okay, EV is now, they were going to have a particular level by 2030, and they're already there. They've already beat it by 2025. Part of that is kind of like, even this weekend, they announced a cash for clunkers type of approach, where they said, we're not only going to give you $13,000 for your family to buy an EV, which, by the way, EVs over there are about $10,000 to $13,000. I mean, as a really, really nice family minivan. We're also going to give you the same amount to trade in your old oil, your ICE, your internal combustion engine. So they want them off the roads. They want no more dependency on the petrodollar, full stop. That is part of the thesis of falling oil demand. So I do the technical analysis with my intermarket and says, something's going to be bearish in oil. And then I go and I say, Robert, can you please explain to me why I see this bearish setup? No, because I don't know the fundamental market. I have no knowledge of the fundamental market.
Robert who? Like, what's his name? So that,
McMahon. Yeah, McMahon. So sorry. He's one of the 10 traders. So I then get to benefit from his subject matter, obsession. That's his core business. And then basically this feeds into then equity positioning, because we are, believe it or not, all carry traders. So even though you were just talking about the yen carry trade, which is that unwind when they're, buying stuff in very, very low cost yen, right? Extremely low interest rates versus, and they're buying speculative assets, et cetera. When that starts to unwind, the yen starts to move higher and the concentration risk unwind, like we had in July, right, to August 5th. Yeah. That was 15% drawdown in NASDAQ in very short order, like we just had basically recently. It was 25% drawdown in SMA to semiconductor, and it was 35% drawdown in NVIDIA, the golden child. So the point is that was a very big trigger for an FX or a currency volatility move. Now, those can also become unwound, right? Yeah. In other words, that reflexive, convexity short covering rally that we had on August 5th. Everything's fine and dandy. Now, this is different now. So now we have potential more triggers of yen carry trade unwind on occasion, but also oil is a carry trade. U.S. Treasuries are a carry trade. So we don't really realize it in equity in retail land
that there are lots of carry trades. It's not just yen.
Yeah.
And we are all bond traders. We are trading yields, full stop. So right in the past, this is also part of that intermarket analysis. In the past, of course, when yields were going up, we would have an equity shock, right? We'd have this kind of growth scare. Oh no, we can't afford it. Now the opposite is happening. When yields are dropping, it's pulling forward recession risk and equities are selling off. The dollar is not going up in risk asset mode with equities falling. Of late, have they? No, they've dropped like a rock. They made a 4 standard deviation move because money's going home. So trying to interpret from, again, this is my intermarket view of cross-asset analysis. It's combining the macro with the intermarket, the technical as well, with the fundamental, and then looking at the flows to go, are they buying this market? Are they hedging this market? Or are they selling this market? And part of that is really breadth and volume and the quant, mechanical stuff that comes in. And right now last week, we triggered a little bit of that, counter trend bounce, or what I call the green shoots of stabilization, because on Tuesday, was it the 10th or Wednesday? I said, okay, so now VIX is going to expire next week, right? Early part Tuesday. And this is going to pull down implied volatility. So those SPY puts are going to have a much harder time moving higher. And more importantly, we can redo this after options expiration, but you're now working against gravity. So this is you're out of luck. You're out of time. So now you roll to April, or you do, we do other strategies around, put spreads now versus direct. You have to do something about this, because it's going to come back down. It's going to deflate that IV, and you're going to get hit. So do I think it's done for the week? Yes. But then after that, I firmly believe it's going to pick right back up again. So I just think we're going to have these waves of volatility, but we still have to play them tactically because of the pressure on dealers and flow, especially around expiration. So that's my look at, for example, how I use quant from a tactical standpoint. I'm still bearish after Friday's OPEX, but from a tactical standpoint, it was time to careful. We're going to have a stabilization and or bounce, but then we have to see if we're really going to get natural buyers stepping in. And so far, I have not seen them.
Yeah, no, I agree. I think that maybe after OPEX, I think maybe a little bit after OPEX, because you have the end of March flows. And there's a lot of positioning at the quarterlies for March as well. I know most famous is that JPM collar thing. But I would keep an eye out there too. You might have a slight
What do you
delay.
think is going to happen after OPEX? I'm talking the Friday, not the VIX.
The actual Friday?
Yeah. After Friday,
so
like what?
I think,
are you bearish, neutral? Don't wait to see.
I think this is a swing dead cat bounce. I am bearish like you are, but probably about late March, early April, we'll see another kind of sharp leg down, like we saw in like the past, 2-3 weeks. There's a lot of that they hedged in this most recent drop. There was a lot of hedging in SPX in particular. And there's there'll be a little bit of positive momentum, but I think like 5,900, 6,000 might be a kind of a peaky area. And whatever it is at the end of March, toward the later part of March, I think that's when we're going to kind of see another rug pull and probably another lower low, at least until like April OPEX, unless they're hedging again. That's it for us. We don't really use technical analysis. I don't believe in it. That's a different story. But I
analyze VIX technically. I analyze mortgage rates technically. Oh my God, everything is technical analysis on top of everything else. But anyway, okay, go ahead.
Yeah, I mean, we do I look at technicals only like levels where their bounces happened, and kind of seeing volume weighted there. Other than that, and I know that's kind of Jay's thing too, right, Jay? But
no, I mean, technically, if you look at it, let me just quickly share my screen here. I think visually this might be good for everyone. If you look at positioning, and to your point, I mean, we didn't have these peak magnets of Vanna here from a dealer positioning. They're now starting to position themselves down to 5,300 here, right? Even 5,350 has started to appear on a lot of these expirations. So I don't think we're quite done. We're going to kind of carry up a little bit, maybe get to this 5,900. I don't even think we're going to do that, honestly, based on my latest trade plan here for this week. But it's not looking, very bullish and dovish for folks. So just beware.
Well, you see all that red there right above price. That's all like in the money puts right now, but they all expire after March. After March OPEX and then March quarterly. And that's why I think we're going to start see the tremors after that. Right now, though, as you stated, implied volatility has got to come down. What's the implied volatility of an expired option? Always zero. Doesn't matter what the volatility has been, and those flows matter. So, but we need to see like a bump, because all that negative right there, implied volatility coming down, actually doesn't help the market until we pass some of these red strikes. Then it will help the market. So the dead cat bounce could go as high even as 6,000 as what, up to these green shoots over here. But from our perspective, of course, but it doesn't have to. I mean, it could be anywhere between. So it's a tough trade to trade the bounce. But I think, and I would never, I'd be very scared to go short gamma too, like selling premium, selling puts in an environment like this, you get hosed. But, but yeah, like that strike right there is the important one in the short term to me. But
which one?
I mean, this is
what's the level? I can't see that.
5680.
Okay.
That'd be if we pass that, then we can probably see like a larger bounce. That's from our perspective. But
so 5680 is a key level for you. When you're doing this analysis, do you ever kind of percentage wise calculate how many calls are bought versus sold, how many puts are bought versus sold, to get kind of a more aggregate look?
So the way we do things at Volland is we consume every single option trade, like every single one that goes on the Oprah feed. We take it in. We have a fair value formula, kind of mimics a little bit what CBOE does. And we see, on which side of that fair value of that option at that time is the trade executed on. And that's how we determine whether dealer or customers are own the option, right? And this is from the dealer standpoint. From that, and because we're consuming every single one, this is more like a histogram of the net open interest. It's kind of like we don't provide the net open interest, because then there's a huge edge deterioration if we do that. But once we do that, then we calculate the aggregate Greeks on every one. First, second, we do calculate third order, but haven't found it to be very useful yet. So we haven't really shared that. But like first and second order Greeks. And we found in our studies that Vanna has the most leading indicator. And it made sense because, dealers, when they hedge, don't hedge Vega very strongly. It's expensive. And, most of the time they just kind of expand price to hedge Vega. And then when price comes back, then they, unhedge basically. Right. So that Vega decay is what causes these like little incremental positive days in a regular bull market. And so that's kind of what we see as the leading indicator for dealer, because if they're not hedging Vega much, Vanna is showing the delta from the Vega decay, and they're hedging deltas religiously. So they're realizing, they're looking at it and seeing deltas come in and like, okay, we'll just hedge the deltas. But we could see the pace at which they need to hedge deltas over the days ahead. So that's kind of why I look at it. That's how I trade. That's my swing trading kind of edge.
Define swing duration. Everyone has a different time frame.
I'm like a month. anywhere between like 2 to 6 weeks, really. I will, if I do see on like a daily time frame, because we do 0 DTE as well, which has like a different dynamic because that's a race against time. But if I do see like a 0 DTE dynamic that's going against my swing trading, I will hedge in a shorter time frame. But mostly I do option structures that are 2 to 6 weeks out.
Good. Okay, that's a swing. That's a proper swing time frame.
Yeah. And then I don't touch it. And then I'm working on development or marketing or whatever. So yeah, because we only have you for 5 more minutes now, and we completely not really talk much about FOMC. What do you see FOMC doing and the flows? And then we can let you go, and we'll talk to Jay about his stuff.
His stuff. All right. Well, I'd love to stick around for the stuff, but yeah, I do. I run a live trading room every morning, so I need to hop into that and see what's going on in the world. We have basically no expectation of Fed change, but there is some language that I'm going to be looking for, which could interrupt the flow. So I basically have one baseline bet, and that is I look for macro event risk, but I'm not a macro trader. I look for macro trends, but they're mostly based on intermarket analysis. From the yield curve steepening or flattening, all that stuff, it's very much a mix. But when it comes to FOMC, the language around stopping QT, which is of the Fed balance sheet, would help give the market a little bit more of a boost in expectation, just like Fed cuts give the boost of a market that's in repair or rise. The difference is I'm not expecting either. So we have retail sales today. We've got FOMC. We've got Bank of Japan, et cetera, et cetera. We've got much, much more data coming in around this consistency of the administration wanting dollar to fall, which is money going home, of yields to fall, which is actually deflationary effect as it relates, and of course, of energy prices to fall. I'm kind of more focused on that as a macro trifecta. And then all of the flows that fight that will see, again, that dead count bounce rejected. And I will know if there's a macro event policy intervention that will then stimulate actual buying. And that would be very hard to see right now because Powell does not want to play ball. And there isn't really anything that Bessent can do until the debt ceiling limit is raised or dealt with. And there's really nothing the administration is going to achieve until Congress stops spending so that yields can fall. So really, there isn't anything that I see coming in from a macro events standpoint, like QE would be extraordinarily inflationary. They don't want that, right? They've been very, very clear they don't want to have inflation. And they're going to punish, until morale improves any inflationary burst. But war is inflationary, right? And so all the stuff that they're doing to talk a forced armistice with Ukraine and Russia, at the same time posturing with Israel to attack Iran, it's all very, very chaotic for markets to get a solid bid higher. And we're so overvalued. And again, yen carry trade can trigger a basis trade unwind, which is that whole, your long NASDAQ 100 and short treasuries. Well, they're starting to reverse that. Point is, I see much, much, much more reason to short the rip from a macro standpoint, from an intermarket standpoint, until there is a policy intervention that can actually put a floor in the market and give reason to move higher. Right now, we're just exit liquidity. As we correct sideways in this big swath, right? We can have a 10% drop, a 5% pop. We're just going to make lower highs all the way for the rest of the year. But the problem is, I think we are starting to get, this message out, right? You're in the same time frame looking at your flows going, we're going to get a bounce, maybe 57.80. That's likely going to get rejected. A lot of other people are seeing that too, and they're going to front run it.
Yeah.
So the more likely that the market doesn't provide that bullish narrative anymore and people catch on to it, that this is really, the market sell-off is a feature, not a bug, which was a thing I did last week. The long and the short of it is they're going to front run these upper call walls or what have you. And that's what actually makes it more dangerous for more volatility. So that's what I'm looking for right now is, yes, we can have some stabilization, we can have a bounce, and then rejection. And everyone's going to be trying to time the rejection based on flows. So keep me posted on what you see.
All right. Yeah. No, we'll definitely keep in touch. We can visit each other's our rooms. So
thank you. But I don't do a shared camera in the morning. Just for you.
You look great. All right. Thank you, Samantha.
If you didn't say that, we wouldn't have known the difference. You look
That's
great.
right. That's right.
All right. Well, I appreciate very much the time. I appreciate meeting you both officially versus just, on FinTwit. And I wish you a fabulous rest of your week. Don't do anything stupid.
No, the pleasure is ours, Samantha.
Thank you, Samantha. Nice meeting you.
Bye.
Bye-bye.
Bye. That was a great interview. What did you think, Jay?
Yeah, no, I mean, it's always good to, bring other traders and their perspectives and what they're seeing, right? I think unlike, kind of like America at this point, we've stopped listening to each other and other points of views, right? So for me, it's refreshing, especially when you hear someone as knowledgeable and who's been trading for quite some time as Samantha has. So I appreciate you bringing her on.
Yeah, the intermarket analysis is very interesting. It's kind of, things that I don't have data on necessarily, but kind of like have an ear toward. And then people yell at me when I start talking about the things I have an ear toward. So I'm like, all right, maybe I should stop. But but those flows though are important because those are like major shock kind of flows. And when you combine it with our analysis, I think that it gives you some good bounds and some good levels to watch for when you're saying, this is actually happening, as opposed to maybe it will happen, right? All right, so let's talk then, Jay. Let's get your trade plan. Let's talk about
let's make
what
this
week coming up.
Yeah, let's make this quick. We got quite a few. Kramer did show up, so thank you, Kramer. Love Kramer coming.
Well, he's not yelling at me yet. So.
Yeah. So we said hello. So there you go. You guys seem to be, figuring your relationship out. So that's a good thing. Let's jump in. Samantha obviously was here. So awesome. This week's catalyst, if you didn't pick up, we had retail sales as expected. Let me just quickly look at it here. Core retail sales came as expected, but the actual month over month came lower than expected. We were looking at a 0.6% forecast. We got 0.2%. And then the Empire State Manufacturing Index just fell off a cliff. We were expecting negative 1.9. We actually got a negative 20 reading today. So,
well, that kind of shares from what happened last week, right? Last week we had the Michigan sentiment, and everybody thinks inflation's going to double and businesses are all going to tank. That was a stagflation expectation right there. It was kind of scary, but let's be honest, I was kind of expecting it too. If I was a part of that survey, which I am not, I would have responded similarly. So similarly to
fix my egg prices first, man. Fix my egg prices first. All right. The other big thing,
just real quick, FOMC has some event vol. BOJ never really has event vol, but it's hard to kind of decipher that event vol from from the overall just high level of implied volatility. It's there, but if implied volatility was kind of at a more average level, we would be seeing, where would it be, right? Like, where would that FOMC be? So, I think that's it's there, and I think it could create a burst to the upside because all that this is OPEX week and VIX-piration. So, it will probably produce a stronger dead cat bounce, and people will like. But then, it could. I still think that 5,900 will show up eventually if we bounce enough. So that's like, to me, that's like the peak. It would be possible, could be 5,900. I know we're at like 56 something too. So it's like 300 points in a week. That's kind of, that would be pretty rapid, right? but I think that would be like an upside extreme. I don't know. I don't think we'll. To be honest, I don't think we'll hit it, but I think it's underpriced that level. So, but then kind of like what Samantha was saying, we'll probably start drawing down again. We'll probably stick in that level a little bit, and then until the end of March, and then like, yeah, because April doesn't look great after the March quarterly OPEX. So.
It doesn't look great. And I'm kind of curious to see how they start positioning, because I was looking at April's like OPEX and not looking so great so far. But let's keep going. I mean, to your point, like they're expecting about 140 points on the week. So that puts us somewhere, at about a 57.80. Ding, 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 that number, right? And then 54.99 to the downside. And for those who just pay attention to this, we did hit below last week's downside options expected move, but we captured it back, right? So 56.17 was the move, the lower end, and we closed at 56.38. So you can kind of see sometimes the option market wants what it wants, and maybe this is one of those weeks, but we'll have to see here. Samantha talked about market breadth. This is something we've been following and talking about as well. Is like it's just getting worse. Like it's not getting better by any stretch of the imagination. Like sure, we have a little bit of a relief bounce here that we saw on Friday or Thursday into Friday, right? You see that with the 5-day moving average kind of spiking back up, but you look at like longer term, there's some damage here. And the 200-day moving average, like you have less than 40% of stocks who are above their 200-day moving average at this point in time. So that list is dwindling, and I don't see this bleeding stopping here. So just be careful, everyone. Caution is warranted, is what I'd like to say. Any thoughts there, Wiz? Okay, let's keep going. So, from a Vanna standpoint.
Yeah, I mean, I kind of gave you most of my thoughts, but yeah, the market breadth has been terrible. I mean, that's showing more underlying economic. Oh, you can't hear me?
It's like cutting in and out. I don't know if it's my internet or yours, so keep going.
Oh, it might be mine, even though I'm on my hotspot too. Can you hear me now?
Yeah, you're good. Yep.
Yeah. Okay. So yeah, I mean, we definitely dropped a bit further than I thought we would. But I think that'll make the bounce a lot more acute too. Then I think it's the underlying economy is going to struggle. I mean, Trump is saying we'll feel some pain. It might be a lot more longer lasting than he thinks. Stagflationary expectations is kind of like a hopeless position for the consumer, right? Like everything's going to get more expensive, but I don't have higher demand for things, so businesses will get crushed and things are getting more expensive at the same time. That's not a great look for us, right?
No. And I think you kind of saw a theme like that between CPI to PPI last week, right? So
yeah.
All right, let's keep going. Some of our key levels here, at least from a Vanna standpoint, I mean, I'll jump into it. 5,600 is a big level here, and we actually held it overnight so far. Wiz, we actually bounced right off of it. So 5,600 is doing what it's doing in the interim. To the upside, I mean, there's just a lot of sellers. Regardless if you look at the option flow, if you just look at shares and volume profile, it's heavy above spot. I'm not going to lie, Wiz, right? And, at least like some of those key levels, 5650, 5675, 80, like to me, this is the week here is pinned on this number. You're north of it, you're going to go chase 5,800 is how I kind of look at it, right? You're south of this. I don't think we're going to get south of it. I think we're actually going to get above and touch this level here this week. Longer term, the more south we are of this, the more bleeding there's going to come, right? And so 75.80 for me, at least for the first start of this week, is a big week level, excuse me. I want to see the bulls overtake this if we go higher. That's the big one.
Yeah, 5680 is the that's the big strike, I think.
Agreed.
Mhm.
Okay, so with that, I mean, VIX, there's a little bit of downside that I see on this. 20 is the big level. If you break 20, you're going to get some more vol crush here, but 20 is the big value on this guy here. 20 and 21, I would even say. So keep an eye just how the VIX does there. In general, for me, the big breakdown was, touching 5,600, letting it rise, and then getting back above 5,625. I think we can start riding this a little bit here, Wiz. I broke it up though. Like, to me this week, again, you have OPEX, like, take profits, guys. It's not about being right this week.
Yeah.
Things are going to randomly happen this week with OPEX expiration. And then we've got the end of the month, the end of the quarter OPEX as well. So, like, things are going to get funky here in the next 2 weeks. Wins should be wins is how I look at them. So take them at key profits. So for me here, if you took the, failed breakdown overnight of 5,600 into 5,625, your next levels, lock them in there. Above 5,680, we can start writing, and above 5,700, that's another set of numbers you can get to. This will be dependent, though, on FOMC, is my opinion, right? Like, I think we can get towards 5,680, but anything above that is going to be very dependent on FOMC. So you want to ride, let's say, 60 points up and then let it sit there, potentially to fall back, and then wait for the volatility. I don't think that's worth it. Lock your profits in, move this week, not worth the risk. Sorry.
Yeah.
Summarize your thoughts.
No, you're right. I think that this is a week to be nimble, like be kind of flat, or, in going into the end of March. The vol event level is 5770 into the end of March. And that, I think that will be, we will probably hit 5770 at some point between now and the end of March. But at this, between now and then, I would be scaled back quite a bit in your sizing and just kind of be ready, because we're going to have another, drop in February. We don't know where it'll be from, though. So, just be ready to capitalize when we start seeing that data coming in. Do you got anything else?
That's it. I spent that up.
Kramer, we have a laundry list from you. Here's your thing. Please post one question that because we're not going to be able to get through all that. Post one question, the one you will most want answered, and we'll get to you toward the end of the show, because we do have a couple other questions. That's what we'll hit. All right.
I love it though. I love Kramer's engagement. Bring it.
I love it too. I mean, but we had Samantha on, so I mean, and we have 9:30 is coming.
Trade, so, right? We got to get trading.
Yeah. Exchange Africa Trader Summit. That's our boys at Tradier, I believe. What are you seeing in the Vanna tea leaves for April OPEX? So, I mean, I'll just, I don't know if you want to share your April OPEX. So from the end, but so if you could do two, one from March to April, and then April 1st to April OPEX.
So
those are two different pictures.
Do you want SPX or do you want the actual VIX instrument?
We'll do SPX. We'll just do SPX for now.
Yep. Right. 1 second.
Yeah, but because that's where the difference is very pronounced. With VIX, it'll be hard because of the mean reversion.
All right, so you have all expiration. Let me get you your the 21st. Boom. There we go. And then you've got your next.
Here, go to date range.
Yep.
And then go the day after March OPEX.
Yep.
Yeah. Through April OPEX. I guess it's April 17th or so.
Yeah, there's a holiday on that Friday.
There's a holiday on April 18th?
Yeah, I don't know what holiday. It showed up as a holiday.
Oh, happy St. Patrick's Day. Speaking of holiday, everybody.
Yeah. Happy St. Patrick's Day. We didn't get this.
And that March 21st one due April 1st to April 17th.
Okay.
And this is to answer questions, so it's not. I don't even feel bad that we're not like prepared for this, but
No,
you see how different that looks.
Yeah. Oh my.
I mean, there's a lot of negative area right there above, and that there's not really much positive below. You see a huge, positive Vanna spike down there. It's a lot more negative Vanna in this time frame than what it was. That's why I kind of think toward the latter part of March into early April, we'll start seeing another drop, at least a bottom or something, maybe another vol event too. We'll see.
Yeah, and for those, like, this is the JPM trade here, so it's coming off, right? We'll have to see where they reposition themselves, but it's typically not this close to spot. I can tell you that. So even if we're in the 5,800 kind of region here by the end of the week, they're probably not going to reposition it at 55.65. I can tell you that.
Yeah. All right. So, Deanne says, you guys do the show every morning? No, we do it every Monday. 8:30 to 9:30. We do kind of a preview for the week. So, thanks for
within
our
watching. Discord, though, just to call it out, we do provide daily plans. You can come in here. We kind of provide the same kind of guidance here. I don't always do it on video. Maybe I should start recording them on video. Maybe I make more sense than my writing does. So maybe I should work on that.
You can make some YouTube dollars too, right?
There you go.
All right. Derek asks, with expiration tomorrow, with the recent volatility, do you expect any return of vol as this exposure rolls off, or will it have a dampening effect? Now, we kind of were talking before, if you missed it, is we'll have probably a sharp kind of rise, dead cat bounce that you'll be able to short, but you don't know what level that is. So you kind of have to be careful. Be careful because you could get burned if you try to short the rising knife, I guess it would be, right?
Yeah.
Yeah. So, all right. So Kramer didn't ask his last question. So I'm going to, I'll quick scan and see which one is one of the causes. Okay. Yeah. All right. So I'm going to do this one.
I think I'm kind of scanning through it. We answered the majority of them. Talking between Samantha and yeah, so I actually feel happy for Kramer. We've answered majority of them.
What are the causes of market down, vol down? How likely is this in the next 2 weeks, especially with no more OPEX support? I guess how likely is it that we'll see vol down, spot down? So first of all, for like the prior, not including last week, the 2 weeks before that into Monday, we had a lot of over VIXing, massive drops in the market with VIX going much higher than it should. Starting on Tuesday, that started getting, a little bit of release, under VIXing. Even though we dropped in some of those days, that under VIXing started happening, like the vol started dropping. That's kind of part of our thesis as to why we think we'll see like a little bit of a spike coming up here. And it's continuing today. If I kind of look, there's a Monday effect too, but kind of continued today a little bit too. Friday was very strong under VIXing. So I do think that we will see kind of like a bounce. I think FOMC is going to create vol down as well. So I do think that this bounce will be sharp, and it'll make people think, oh, bull market again, yay, that kind of thing. People get reactive to price very, very swiftly. But I do believe it will be on a swing time frame, a dead cat bounce, and so I guess the causes of market down, vol down is overreaction prior to it, right? Most of the time. And then, the vol up, VIX up kind of dynamic is because we start heading into those sold call area. and we start crossing major Vanna strikes. So that's usually what happens then. So if you have anything to add there, we got 10 minutes till trading. So
no,
so, yeah.
I think you nailed it. Take it a little bit easier. There will be other weeks to trade that won't have as much volatility or unknowns, and you have OPEX, which is always a weird week in itself. So caution. Just make it out this week, right? Let's get to the other side of this week, and I think there'll be a little bit more clarity.
All right. Thank you, everybody, for watching, and may Volland help you in your future trading ventures.
Thank you.